Understanding Trump's 2025 tax changes, what you need to know. Trump's Big Beautiful Bill has introduced significant tax modifications for 2025, and here's what you need to know about how they could affect you. On July 3, 2025, Speaker of the House Mike Johnson, Republican Louisiana, officially signed the One Big Beautiful Bill Act during a ceremony attended by fellow Republicans in the Rayburn Room at the U.S. Capitol in Washington, D.C. Just 2 weeks have passed since President Donald Trump's Big Beautiful Bill was enacted, and financial advisors and tax experts are still analyzing the implications of this extensive legislation for their clients. Several of the changes outlined in the bill will take effect in 2025, impacting tax returns that will be filed in 2026. While the Trump administration has been advocating for working family tax cuts, the actual effects of the legislation can vary greatly depending on individual circumstances. Some of the updates are quite intricate, as noted by experts in the field. There are just so many moving pieces, remarked Jim Garino, a certified financial planner and managing director at Baker Newman Noyes in Woburn, Massachusetts. He is also a certified public accountant. ###Key changes to anticipate for 2025. As financial advisors conduct projections, often spanning multiple years, to assess how the new provisions might influence taxes, it's crucial to understand that without proper income planning, you might inadvertently diminish or even forfeit various tax benefits for which you would otherwise qualify. Garino emphasizes that in tax strategy, you never want to do anything in a silo. Here are some of the pivotal changes from Trump's legislation that you should be aware of for 2025, along with their potential effects on your taxes. #Extensions of Trump's 2017 tax cuts. The Republicans' flagship legislation has made Trump's 2017 tax cuts permanent, which included lower tax brackets and increased standard deductions, among other provisions. This move broadly reduces tax liabilities for many Americans. Without this extension, a significant number of filers could have faced higher taxes in 2026, as highlighted in a 2024 report from the Tax Foundation. The new law not only maintains Trump's 2017 cuts but also introduces additional tax breaks starting in 2025. The standard deduction will rise from $15,000 to $15,750 for single filers and from $30,000 to $31,500 for those married filing jointly. The child tax credit will see an increase in the maximum benefit from $2,000 to $2,200 per child. For those who itemize deductions, there will be a temporary increase in the cap for the state and local tax deduction, SALT. In 2025, the SALT deduction limit will be $40,000, a significant jump from the previous $10,000 limit. However, this higher SALT benefit will phase out for incomes between $500,000 and $600,000, potentially leading to an artificially inflated tax rate of 45.5%, a phenomenon some experts have dubbed the SALT torpedo. This creates a sweet spot for the SALT deduction for those earning between $200,000 and $500,000, as noted by CPA John McCarthy in a recent blog post. #New tax changes introduced for 2025. Trump's tax and spending bill has also rolled out several temporary tax breaks effective for 2025, some of which were proposed during his 2024 presidential campaign. These include a $6,000 bonus deduction for certain older Americans aged 65 and above, which phases out for single filers earning over $75,000 or married couples filing jointly earning over $150,000. New deductions for tip income, overtime earnings, and car loan interest, each with specific eligibility criteria. #The return of the premium tax credit, subsidy cliff. During the pandemic, Congress enhanced the premium tax credit, making marketplace health insurance more affordable through 2025. However, Trump's legislation did not extend this enhanced tax break, which could lead to increased Affordable Care Act premiums for over 22 million enrollees if no further action is taken, according to KFF, a health policy organization. This situation could significantly affect enrollees as they select ACA health plans this fall. Starting in 2026, enrollees will need to brace for the ACA subsidy cliff, where they will lose the premium tax credit if their income exceeds the earnings thresholds by even a single dollar. Currently, most ACA enrollees receive at least a portion of the premium tax credit, but the subsidy cliff means that once earnings surpass 400% of the federal poverty limit, the benefit is lost. For 2025, this threshold is set at $103,280 for a family of 3, as reported by the Peterson Center on Healthcare and KFF. #Conclusion. As we navigate these changes, it's essential to stay informed and proactive about how they may impact your financial situation. What are your thoughts on these tax changes? Do you believe they will benefit working families, or do you see potential pitfalls? Share your opinions in the comments below. Trump's 2025 tax changes, what you need to know. But here's where it gets controversial. Trump's big beautiful bill is shaping the future of tax policy, and its implications for families are more complex than many realize. As the law takes effect in 2025, experts warn that the changes could redefine how Americans manage their finances, especially for those navigating income, deductions, and tax credits. Here's what you need to know. The law permanently extends Trump's 2017 tax cuts, which slashed federal income taxes by nearly 30% for middle-class households. Key updates include a $15,750 single filers and $31,500 married couples standard deduction boost, along with a $2,200 increase in the child tax credit. However, these changes come with caveats, especially for high earners. For instance, the SALT deduction, which allows taxpayers to deduct state and local taxes, now carries a 45.5% tax rate for incomes between $500,000 and $600,000, creating a SALT torpedo that could push families toward higher tax rates. Experts argue this creates a strategic sweet spot for taxpayers earning between $200,000 and $500,000, a range where the SALT deduction becomes more beneficial than others. Meanwhile, the law introduces temporary tax breaks for specific groups. For example, a $6,000 bonus deduction for seniors aged 65 plus phases out at $75,000 for singles or $150,000 for couples. This change aims to support older Americans, though critics say it may disproportionately affect lower-income retirees. Additionally, new deductions for tip income, overtime pay, and car loan interest are set to expand, but eligibility varies based on income and employment status. A major concern is the premium tax credit cliff, which could raise health insurance costs for over 22 million Americans if the law doesn't extend the enhanced subsidy. Under the current arrangement, enrollees lose the premium tax credit when their income exceeds 400% of the federal poverty limit. For 2025, this threshold is $103,280 for a family of 3, up from $10,000 in previous years. CFP Kate Dorr warns that this could force enrollees to choose between cheaper, less comprehensive plans or higher-cost, more robust options. The law's complexity means advisors are advising clients to run detailed projections for multiple years, as some provisions, like the SALT torpedo, could shift tax rates dramatically. Certified financial planner Jim Garino emphasizes that tax strategy shouldn't be isolated. Instead, it should consider broader economic factors. As the bill moves forward, debates over its fairness and effectiveness persist. Will these changes ultimately benefit middle-class families, or will they create new challenges for high earners? The answer may lie in how individuals navigate these updates, but one thing is clear: Trump's big beautiful bill is leaving no one untouched. What do you think about the potential impact of these changes on your financial planning? One big beautiful bill, tax benefits for Americans in 2025. Get ready for some exciting tax news, folks. The One Big Beautiful Bill is here to shake things up and offer some fantastic benefits to Americans. But here's the catch: you need to start planning now to make the most of these new provisions. While the no tax on tips and overtime and the senior bonus deduction have been widely discussed, there's so much more to uncover. Get ready for some tax-saving strategies that will leave you feeling like a financial wizard. Charitable contributions, a game changer for all taxpayers. One of the most significant changes is the permanent return of the charitable contributions deduction for those who take the standard deduction. This means that even if you don't itemize, you can still benefit from giving back. During the pandemic, the CARES Act offered a temporary deduction for cash donations, but now, with the OBBB, you can deduct up to $1,000 per person or $2,000 per couple for charitable contributions. This above-the-line deduction is a powerful tool to lower your adjusted gross income, reducing your tax liability and potentially opening doors to other deductions and credits. Auto loan interest deduction, a first-time feature. Here's something that's never been done before: the OBBB makes personal auto loan interest deductible for non-itemizers. That's right, you can now deduct up to $10,000 of interest on your taxes, but there are some specific requirements to qualify. The purchase must be a new, US-assembled vehicle for personal use, and there are income limitations to consider. But if you can meet these criteria, it could significantly impact your decision to buy or lease a car and how much you'll pay overall. Family benefits, more support for parents. Families, listen up. There are two fantastic benefits you should be aware of, even if you take the standard deduction. First, if your employer offers a Dependent Care Flexible Spending Account, DCFSA, you can contribute pre-tax dollars to cover the cost of care for a child or an adult who needs assistance. The OBBB permanently increases the annual maximum contribution to $7,500 or $3,750 for married couples filing separately, which is a significant boost from the previous $5,000 limit. Second, the Child and Dependent Care Credit, CDCC, is getting a double upgrade starting in 2026. The credit rate increases to 50% from 35% of qualifying expenses, up to $3,000 for one child and $6,000 for two or more children, for families with the lowest incomes. Additionally, the income threshold to receive the lowest 20% credit has increased to $206,000 for married couples filing jointly and $103,000 for individuals. These changes will provide nearly 4 million families with an increased tax credit, ensuring more affordable access to quality child care and early learning programs. With some careful planning, you might even be able to score an even larger credit. For example, increasing your 401k contribution could reduce your taxable income, leading to a bigger CDCC in 2026. So, there you have it. The One Big Beautiful Bill is packed with tax benefits, but it's up to you to take advantage of them. Start planning now, and don't forget to keep an eye on your income levels, as many of these changes come with phase-outs. Stay tuned for more tax tips and keep the conversation going in the comments. Are there any other tax strategies you're excited about with the OBBB? Let's discuss.